too many people betting on negative interest rate policy, or NIRP, or even more NIRP in the European Union. So in July of 2019, something had happened that had never happened before with interest rate swaps. These are derivatives. Warren Buffett has called derivatives weapons of mass financial destruction, or financial weapons of mass destruction. So it's just insane. The amount of derivatives in the global economy is insane. It's actually shrunk a little bit according to the data, and I'll talk about that later, from the Bank of International Settlements and the ISDA swaps info, but I think they use the same data. So if you're not familiar with the damage that derivatives, over-the-counter derivatives, did, there was approximately, according to research studies from the University of Chicago, about an additional $5.7 trillion in mortgage-backed security derivatives and credit default swaps that led up to 2008. So the large U.S. banks had massive amounts of leverage. Bear Stearns was leveraged at 60-1, which means that if the value of the assets they had so much leverage on their balance sheet, and they were holding assets with so much leverage, and some of the assets in air quotes, because some of them were toxic and not really worth the value that Bear Stearns was claiming, and that if the value of these assets, again in air quotes, dropped about 1.5%, not even 2%, then Bear Stearns was insolvent and bankrupt. And Lehman Brothers was leveraged at 40-1, which means that Lehman Brothers could only withstand not even a 2.5% drop in their asset prices. And on top of this, like I said, there was an additional, if you want to go out and read books about this, there was an excellent book by Michael Lewis, The Big Short. I read the book long before the movie came out. They made the movie a lot more entertaining than the book. The book was very informative. The movie was very entertaining. It's very difficult to explain derivatives to people. I'm not a derivatives expert. I only know maybe a little bit above the basics. I, honest to God, do not want to know about what is inside a lot of these mortgage-backed security nonsense, and what's in interest rate swaps, and what's in credit defaults. I don't want to know a lot of this stuff. The average person on Main Street should not have to know any of this stuff. And yet for some people, their financial livelihood may depend on it. So anyway, the Wall Street doomsday machine, and I talked about this in the last week or two. I did research on the new Wall Street doomsday derivatives machine, that Wall Street, because no banksters went to jail, because the bankers were fined, and the bankers didn't even pay their own fines. They used shareholder capital to pay the fines. They didn't even pay their own they didn't even pay their own fines, okay? They used shareholder capital to pay the fine. So the bankers got to pocket their stock options, their bonuses. The incentive structure was the fraud, manipulation, lies, all this accounting fraud, all this stuff they benefited from. So no one went to prison. This is when the rule of law really started to go to shit after 2008, and then things have just gone progressively worse since then. Then that's why you have this James Comey nonsense, because look at what he got HSBC Bank off criminal charges for knowingly laundering. He was hired as a fixer, given many millions of dollars and HSBC Bank knowingly laundered many billions of dollars in drug cartel money, organized crime money, and also terrorist organization money. But anyway, back to derivatives. So like these interest rate swaps, the currency swaps are the currency swaps for corporations and also investment banks are different than the central bank to central bank currency swaps. There's explanations of those in Investopedia. So if you don't know what an over-the-counter derivative is, a derivative is a security with a price that is dependent upon or derived from one or more underlying assets. Its value is determined by fluctuations in the underlying asset. The most common underlying assets include stocks, bonds, commodities, currencies, interest rates, and market indices. Depending on where derivatives trade, they can be classified as over-the-counter or listed, and over-the-counter derivative trades off major exchanges and can be tailored to each party's need. How the over-the-counter derivatives work. How the over-the-counter derivatives work. Over-the-counter derivatives are private contracts between counterparties. Unlike over-the-counter derivatives, listed derivatives are more structured and standardized contracts in which the underlying assets, the quantity of the underlying assets and settlements are specified by the exchange. So the European banks, especially Deutsche Bank, which according to many estimates has around $49 trillion all by itself just in derivatives. Obviously, Deutsche Bank cannot afford to pay that. And the European banks have gotten involved in this derivative stuff. They've gotten involved with the euro-dollar market. The European banks were the first banks that were involved in the euro-dollar loans, which, by the way, were illegal because the U.S. still had an international gold standard. The euro-dollar market was violating the international gold standard, and the European banks were lending, creating money and credit out of thin air, again, violating the international gold standard. And then the American banks, if you're familiar with the history of the euro dollar, started opening up European branches and copying them. But back to 2008. So these collateralized debt obligations, or CDOs, mortgage-backed securities, or MBS, collateralized mortgage obligations, CMOs, credit default swaps. There was the estimates are around $5.7 trillion of these, in addition to the massive derivatives that were before, but an additional $5.7 trillion were allocated just for the U.S. for the real estate market, and they were a doomsday machine. The Wall Street banks basically hired rocket scientists. They hired people with PhDs in mathematics, PhDs in basically rocket engineers, like I said, rocket scientists, to design these derivatives. And the majority of people inside the bank didn't even know how dangerous or how risky the stuff that was in there. They only cared, and I've heard this from reading people who left Wall Street and were somewhat involved in the departments. Their bosses really only cared that it was going to make money and that their lawyers could cover their asses in lawsuits. So they figured that the moral hazard, that they would not go to prison for the fraud, and that they would only have to pay fines. And the fines weren't even their own money. So the derivatives machine is a disaster. And these interest rate swaps, like I said, for the first time in July of 2019, the 10-year interest rate swap in the European Union went negative. So it went below zero. In my opinion, my educated guess why it did that is more people are betting on continued negative interest rate policy from the European Central Bank, from the ECB, because the ECB has talked about going further negative and doing further rate cuts, like I said, going further negative, and also quantitative easing program. And the reason someone would want a interest rate swap contract is if interest rates are going to go negative, you would not want a fixed interest rate. You would want a variable interest rate, because then your interest rate payment is going to get cheaper and cheaper, maybe even negative. So the bondholder then is going to get screwed. So if you're on a variable interest rate contract, and so an interest rate swap, basically, it explains this in the Investopedia in the basics, is where someone has a exposure to fixed interest rates, and someone else on the other side of the trade has an exposure to variable interest rates. That means if interest rates go up, they take that risk. If interest rates go down, they take that risk. Or in this case, if interest rates are going down, that would benefit someone else. And what happens is, normally the other counterparty is a large investment bank, and normally they swap. So it's a trade, it's a swap. So someone then is trying to, and I think this is why the demand for these negative interest rate swaps is showing it like that, is someone is trying to, these counterparties, a lot of people are betting, they want exposure to variable interest rates, betting that the European Central Bank will continue to force more and more negative interest rates, more harsh negative interest rates, more draconian negative interest rates. And my friend Daniel Lacaille, he's written great articles about all the problems in the European Union with savers, with the banks, with the insurance companies, with the pension funds, all the collateral damage that negative interest rates has already done. And here you have more people betting on a continuation or worse of these policies. And you have people inside the Federal Reserve here in the United States who want them too. So just more and more craziness. The amount of interest rate derivatives, I just looked this up. The website is swapsinfo.org, and they actually keep charts of the notional outstanding. So if you want to see in a chart form, maybe I should do another video on this another time. But they show the size of the interest rate swap market, and the interest rate swap market right now has, if you count the options on interest rate swaps and the FRAs, which are forward rate agreements, and they're over-the-counter contracts between parties that determine the rate of interest to be paid on an agreed-upon date in the future. And FRA is an agreement to exchange an interest rate commitment on a notional amount. The FRA determines the rates to be used along with the termination date and notional value. FRAs are cash settled with the payment based on the net difference between the interest rate of the contract and the floating rate in the market called the reference rate. The notional amount is not exchanged, but rather a cash amount based on the rate differentials and the notional value of the contract. If you want to read more, there's a lot of very complicated math that goes into this stuff. They only explain the basics in this Investopedia article. The average retail person doesn't need to know any of the specifics. Wall Street is paying some of these guys very, very big bucks to understand this stuff. But the bottom line is that there's, if you add up as of December 31st, 2018, if you add up the total amount of interest rate swaps, FRAs, and the options on interest rate swaps, it is at the total notional value is at $436.5 trillion. That's a pretty crazy number. Now, the gross market value, which they claim is a more accurate measure, is only 6.4 trillion. But you know what? I see the larger number at 436, the notional value, meaning that if one counterparty fails, if Deutsche Bank fails, or an Italian bank fails, or one of the other bad German banks fail, or one of the French banks fails, or one of the Spanish banks, which are in bad shape. Italian banks and Spanish banks are in very bad shape. The French banks have counterparty risk with the Italian banks and the Spanish banks. So if any one of these banks, pretty large banks, fails, it could set off a chain reaction, dominoes, daisy chain, pick your analogy. And that's where the people that are claiming that the derivatives doesn't matter because everything nets out, that's where the hole in the chain exists. That's where the thesis that everything nets out and there's no big deal with the derivatives problem, because we know that Deutsche Bank is the biggest problem. I learned from my sources that Deutsche Bank has been bailed out basically on life support, a zombie, an undead zombie, for many, many years. Really, Deutsche Bank never really recovered after 2008. It just kept hemorrhaging more and more and more. The fact that Deutsche Bank's still alive now is a minor miracle. And a manipulation miracle, as evidenced because I showed you the stock chart from about 2 or 3 months ago. I showed you all the falling knives in the Deutsche Bank stock chart, where the Deutsche Bank stock price was rescued and more time was bought for the shares. Also, the ISDA, and I'll attach links to this if you want to keep track. If you want to really get into the stuff and dive into the weeds, I honestly don't really want to even cover this, but I thought I should bring it up to you guys. I just don't like derivatives at all. I think in general, a lot of these derivatives are just very dangerous and stupid. But the interest rate derivatives, so far at the end of August 16th, so the total traded notional and trade count increased by 13% and 11% compared to the year before. So there are more of these derivatives being traded. The total notional outstanding and total trade count increased by over 10% in the last year. And this tracks it on a weekly basis. This website, for free, the ISDA Swaps Info. And I'll attach links to this. They have a weekly trading volume, interest rate and credit derivatives weekly trading volume. So if you want to keep tabs on this, if you want to look for spikes, if you want to look for warning signals about a specific derivative. And the reason I brought up interest rate swaps is the majority of over-the-counter derivatives, guys, is interest rate swaps. The majority is interest rate swaps. So there's other types of derivatives, but the majority of derivatives are interest rate swaps. The Bank of International Settlements keeps a tab on total derivatives, and they release a report. I have the website here. They release a report and they update it. I think it's monthly. It's OTC derivatives outstanding. So if you want to take a look, I'll put that website in the information and comment section, and they update monthly on derivatives changes. What types of derivatives? So whether it's interest rate swaps or equity linked derivatives or credit default swaps, foreign exchange derivatives. Just crazy stuff, guys. So this is definitely the bizarro world that now not only do we have all these yield curves going inverted, throughout the global economy, U.S. yield curve becoming more inverted. We have $1 trillion of negative yielding corporate debt, which is just insane. It was only $20 billion of negative yielding corporate debt in January. So the chart, if you want to see, one of the scariest charts I've ever seen is the rise in negative yielding corporate debt, which went from $20 billion in January of 2019 up to $1 trillion today. So less than 9 months. Less than 9 months, it went from 20 billion to over $1 trillion. You have that. You have Argentina and you have Japan talking about 50 and 100-year bonds. The U.S. talking about 50 and 100-year bonds. Just lots and lots of craziness. You have central bankers either doing QE, either doing more QE, talking about more QE, talking about negative interest rate policy, not just ZIRP, not just zero interest rate policy, but negative interest rate policy. And then you have LIBOR going inverted, and now you have, on top of all this nonsense, you now have a negative interest rate swap. So no wonder gold is doing well in every currency, even gold prices in US dollars, because this is all insane. No wonder that flight capital is leaving stock markets and emerging markets, is leaving the European Union, is leaving China, and coming to the US Treasury market. All this stuff is nuts. This is historically unprecedented. This makes a lot of this stuff, guys, the amount of crazy news that's coming out in the last 6 to 12 months is accelerating, but all of this stuff makes like 2006 and 2007 look pretty damn tame. Because back then it was just a real estate bubble in the US and the derivatives tied to it. And the derivatives back then was, like I said, just for the real estate derivatives. It was the research came out later, 5.7 trillion in derivatives with the mortgage-backed securities, collateralized mortgage obligations, all that toxic stuff, the credit default swaps, other things. And the credit default swaps were very perverse because you could basically, if you were a bank, you could bet on another bank failing and then start shorting their other shares. There wasn't rules to prevent that. So it was, the analogy that people were using is that you could bet on someone else's house catching on fire and set the fire yourself. I got some super chats rolling in. Thank you, Sam. Thank you, Dan. Thank you, Martin. I appreciate it. Dan Davidson says, I'm your tour guide through this global economic madhouse. That's a good one, Dan. I love it. Choo choo, the crazy train has no brakes. Yeah, in fact, Dan, I think the crazy train is speeding up. I think Trump and other people, I think their idea is, let's grow out of this. Let's accelerate. Let's try to jump the cliff. It's kind of like, did you ever see the movie Thelma and Louise? It kind of reminds me of that at the end. Thank you very much for the super chat again, Tarquinus. Is the ECB cutting rates further? Yes, the ECB has they have a meeting coming up in September, and they have telegraphed that they plan on announcing continued or more QE and then also rate cuts. And this is why you have all these people jumping on, in my opinion, my educated guess, on the interest rate swaps, because you have way too many people betting who want the variable interest rate. They don't want a fixed interest rate. They want a variable. If they get a variable rate when interest rates go lower or go more negative, then their payments are less. Do I think they will repo stuff? You misspelled that. Do I think they will take stuff when it all crashes? I'm not sure what you mean there. Hey, Bill, thanks for joining the live stream. I appreciate it. Good to see you, Max. Someone told me there's an additional notification for live streams that you can click on. I'm not sure about that. I haven't checked. But thank you to all my Super Chat people, and thank you very much to the 100+ Patreon account contributors who are making my life a lot easier, a lot less stressful, allowing me to actually plan for a future for growing this channel out and other interesting projects that I can work on in the future. It's very much appreciated. Because although my Google AdWords revenues are up, you never know when Google might pull the plug. Shane says still want to see the Deutsche Bank link that Kyle Bass was alleging refinancing the Chinese. Shane, I think Kyle Bass he's more on the HSBC Bank. So Deutsche Bank could be involved, but Kyle Bass from his Twitter, are you monitoring his Twitter? From what I don't check his Twitter every day, but from the last time I saw something about the HSBC Bank, he was only talking about HSBC Bank. Santana says the U.S. will be the last to fall if it happens. Yeah, that's what it's looking like. It's looking like a lot of flight capital is coming here to the U.S. Treasury market. But that's very similar to what happened to the U.S. from 1927 to 1929 prior to the October 1929 crash. Jesse, if the U.S. goes full negative, on rates, the insurance companies will collapse. The insurance companies at that point, Jesse, would all need bailouts. They would try to raise insurance premiums on people, but a lot of people wouldn't be able to pay. The insurance companies, not only would the insurance companies, because they are legally required to buy bonds, especially U.S. Treasuries, but other types of bonds, the insurance companies have enormous bond portfolios, and they also have enormous exposure to these collateralized loan obligations, which I covered exclusively compared to a lot of other channels. I found a Fed research report that other people did not find. I'm not even sure if Zero Hedge brought it up. And the insurance companies were buying up that CLO toxic sausage garbage like crazy. So some of these insurance companies were desperate for yield and were buying that stuff up. So not only do these insurance companies, would they be massively hurt? Insurance companies need the cash flow. They need the yield. So the higher capital gains from the bond market would not help out insurance companies. Insurance companies need the yield from the bonds to reinvest. So I have Investopedia articles on the very basics of derivatives, like what's an over-the-counter derivative, how they work, what is a swaption if you want to get into that, what is a forward rate agreement, what is an interest rate swap, and then I have links to the ISDA website there. The ISDA website is particularly good. They also have a pay section if you're more sophisticated, and then the Bank of International Settlements also does a monthly report that they put out. The European, so I found this chart that you guys are looking at. The Financial Times actually tracks this, the Euro 10-year swap. So I'll put a link to that if you want to track this to see. But it's a crazy chart, isn't it? So my educated guess is lots of people, it's a way overcrowded trade. So if interest rates were to reverse, I'm not saying that will happen, but if they were to reverse, if interest rates for some reason were to go higher, if central banks were to lose credibility, lose control for whatever reason, then there would be lots of hedge funds, lots of investment banks probably that are betting on this, lots of pension funds blowing up. Same thing with the leverage short volatility trade on the VIX. Massive, massive over leverage on that trade, on the leverage short volatility trade. Negative interest rates also kill savers. They kill savers. They hurt the negative interest rates. Basically, guys, they hurt everyone but the over-indebted governments that are issuing more and more government debt. Negative interest rates hurt everyone. And negative interest rates might not hurt some of these corporations that have junk bonds that are able to issue at lower and lower rates. Or even in Europe, we found like in the last 2 months, there was 14 companies that were able to issue negative yielding junk bond debt. So negative interest rates would help them temporarily, but then those guys would probably just issue more debt and get themselves in more trouble. If you're issuing negative yielding junk bond debt and you're playing the refinance game, which means that you can never, if you're a corporation and you can never pay off the principal on the debt, and you can only keep refinancing, hoping for lower and lower rates just to keep the lights on, you're in trouble. I mean, you're having to swim faster and faster to keep your head above water. You're buying a shitload of toilet paper from Alibaba. Santana, you may want to stock up there's coupons at like Costco or BJ's Warehouse and get the Charmin Ultra Soft before they start to reduce, get the higher quality toilet paper, and then you'll be able to trade it for better value later. Before they reduce the packaging a lot further. Buy the higher quality stuff. Some people will overpay. You'll be able to sell it at a premium in the future. Those 60 rolls, I don't even know if anyone, I don't think they sell the 60 rolls anymore of the 12 pack that I used to buy. I think it's down to like, it says like 54 roll equivalent or 52 roll equivalent. I forget what it said on the package. I haven't looked at it since I did that video. I haven't looked at the exact details of the package. I'm sure though that they'll be reducing it again probably in another 4 to 6 months. Remember I did that shrinkflation video and I read a lot of the comments you guys put about all the craziness going on with reduced portion size and shrinkflation. It's just crazy. I also just saw a brand new infographic that Match.com did, and they were showing, based on a survey that the people on the Match.com dating website did about all the inflation for dating in all the different states in the United States is pretty crazy. On how much the average date costs. I think it's almost $300 for the average date in New York. It's like $260 or something in New Jersey. It's $225 in California. The numbers are nuts. The infographic is in the Wall Street for Main Street Facebook group if you want to see it. I may do a video on that. Although if I do a video on that, then it's going to have red pill dating stuff in it, and you guys didn't come into this channel to hear that. So I probably should avoid that, because the red pill dating channels all get like demonetized, and I think I'll avoid that. Okay, guys. Well, I'm getting tired. Thank you, everyone, to the super chat. I appreciate it. And I'm going to go relax now. Everyone have a nice rest of your week. And have a good weekend. It's Labor Day coming up here in the United States. And I may have a video for tomorrow. I did try to send out some emails for some interviews, and I didn't hear back. So I guess a lot of these experts that I try to interview are on vacation. A lot of people are taking it easy. I'm not. I'm still hustling. I'm still working hard. I think I've taken off like 1 or 2 days in the last 3 or 4 months. Just cranking out content for you guys. So thank you very much again to my 100 plus Patreon account contributors and the people who also donate one time on PayPal or on a monthly basis on PayPal. It's much appreciated. I'm still trying to figure out. I'm welcome to suggestions. There's been a couple suggestions on how I can provide more value for you guys only to the Patreon account contributors. That would be on like a Vimeo video. Now you can link your Vimeo video account, so it's only Patreon account contributors. So I'm going to start looking for other suggestions and debating how I can provide additional value on that. So I'm done for now. I'm going to go relax. And if you want to do more research on these derivatives, maybe go relax a little bit, go work out, or go have a beer when you're researching these derivatives, because it'll start giving you a headache the more you try to learn about them. It's a disaster. It definitely is a accident waiting to happen.